our first live stream, so we'll see how it goes. Appreciate you all coming for it. So let me share my screen. So the format for this is going to be quite informal. Yeah, any questions you have, I'll do my best to answer them. So yeah, this is the last time we'll be using this slide deck. We've just gone through a rebranding with our external partners, which I'm very excited to show you. So the website is going to be updated very soon. The whole brand decks that we use and our investor decks will be completely redone as well. So excited for everyone to see that. Okay, great. So banks for communities and not banks for bankers or banks for banksters is what we're trying to do here. We're trying to found community banks globally. So our mission at Valhalla Network is to have a whole global network of community banks to help small businesses that are currently underserved by the big banks. So for us to figure out what the solution is to the current issue and how Valhalla Network can provide it, we first need to get a good understanding of the problem with the system. We need to know where there are mistakes, what people don't understand, what the banks are doing wrong. So to kickstart, we should look at the misunderstanding. And this is probably the worst problem there is, because people all around the world, I'd say even 99% of bankers, certainly when I worked at HSBC, the majority of bankers didn't understand what a bank actually was. And it's understandable because in mainstream economics, we are taught the incorrect things. When I joined HSBC, the first week I was there, they brought in an external firm to teach us about banks, and they taught us the wrong thing then and then. And when I questioned them on it, they didn't actually understand that banks create money. So people believe that banks are these financial intermediaries. They believe that they just move money from one person's account to another. They take deposits and they use those deposits and they lend them out to people, they lend them out to borrowers. However, that's not the case. It's much more complicated than that, and banks serve a much more important role in the economy. In reality, they're creators of money. They're creators of 95% of the money supply that's actually created. It's not through the central bank. The central bank accounts for about 5%, but 95% is the private banks, the commercial banks in your country. So the role they have impacts your everyday life. It decides which industries do well, which ones do bad. Now, if banks are the bloodline of the economy, small businesses are the backbone. Now, small businesses account for roughly 65%, 2/3 of employment. And also over 90% of firms are small businesses. And unlike big businesses, which can raise money through capital markets, through bond issuances, or just through other investors coming in and stuff like that, other means of finding funding, small businesses rely heavily on bank funding for their external finance. However, despite this, and despite their reliance on the banking system, you won't be surprised to hear that the banks are underserving them. So as mentioned, small businesses rely heavily on bank funding. But despite this, banking systems are not serving them. They're becoming more concentrated. The banking system has large banks lending to large businesses. They don't care about the small businesses. Now, this is understandable again, because if you're an investor in a big bank and you're a shareholder and you're demanding that the bank grows by 5% a year, it's easier for the bank management to grow by 5% by lending very large loans to large PE firms that are using it unproductively. But anyway, it's easier to do that than to lend thousands of small loans to those small businesses in the country. So it's understandable why they're not catering to the small businesses and they're catering for those large firms. And the large firms are important and banks do need to cater for them. But what we do need is small banks to lend to small businesses. But despite this, about 50% now of banks across the EU have disappeared. What's actually happened is the big banks have bought them up. They've acquired them. They see a small business profiting, they see a small bank profiting, they see it doing well, and the big bank will just go up to it and buy it up, acquire it. Now, what this means is that small businesses across Europe, across America, across the UK, and across actually everywhere in the world are now struggling to find any bank that's going to lend to them. And a recent survey we did at Local First in the UK, in one geography of the UK, where we interviewed about 100 small businesses, we found that over 2/3 of small businesses we interviewed don't even approach their bank to ask for a loan, because of the hassle and the fear of being rejected as well. They don't even approach them. And over 95% of the small businesses we interviewed would seriously support a community bank starting up in their area. Now, what does this lead to? Well, you've got recurring boom bust cycles. As these big banks buy up the small banks and they become larger and more concentrated banking systems, and you're not lending to these small businesses, you get these unhealthy economies, you get The large bubbles are being formed through this unproductive credit creation, which I'll go into in a minute. And then you get these bust cycles leading to inequality, bankruptcies, mass unemployment. Of course, a few people get very rich in any time like this, but that's not normally those small business owners who are really struggling. And this is because the big banks are doing things wrong. They're lending unproductively to these big firms, and they're not catering to the real small businesses that are the backbone of the economy, the productive credit, the productive use of credit, those productive businesses that are actually the main employer in any economy. Now, the red line indicates what a system like Valhalla Network can do, what we're trying to do. We're trying to get this healthy economic growth without inflation and without these recurring boom-bust cycles. It's just gradual, healthy growth by lending to small businesses. So how do banks actually create credit? So I've said that they're creators of credit and they're important and the role they play and they can't be replaced. But how do they actually do it? So a lot of people in the world, like I said, about 99% I'd say don't know that banks create credit. They still don't know it. And a lot of people in blockchain as well and in Web3 and especially in the DeFi space don't realize this either and believe that DeFi and non-bank projects can replace a banking system. Projects like Aave, for example, that provide a decentralized lending and collateral and all that tool that people can go in, post collateral, and they can get lending and they can borrow like that. They believe that can replace the banking system. However, DeFi protocols do not create credit. Yes, they might have their own token, they might have their own coin, and they can mint that coin and stuff. That coin still has to be bought with USD or euros or fiat of some sort. They don't create fiat currency. That is the key part, whereas banks create this credit, so they can't be replaced. So how do they do it? So as banks lend, what they're actually doing is buying a promissory note. They're not just lending money. When a small business approaches banks, let's say, the small business is actually giving a promissory note to the bank and the bank is purchasing it, it's purchasing a security. And instead of on the liability side, it's saying, well, look, we've got £200 in deposits, let's say right now. And on the asset side, we've got £200 in cash because, you know, John Bloggs has deposited £200 with us. So instead, what they'll do is instead of like a normal company where they'll say, right, that £200 in cash, we're now lending that out to the small business. And now we have a loan on the asset side of our balance sheet. In fact, what they do is they say, yes, we're purchasing a promissory note, but instead of giving that £200 in cash to the small business, what we'll do on the liability side is just mark them as having £200 deposit in their bank account. So only banks can do this. And what this means is they're lengthening their balance sheet. They're creating new money, which money hasn't been created elsewhere. And no one do this, only banks. Now, how they do this, and sorry, did someone say something?
Yeah, that was me, Ollie. The difference here can't be overstated because like you go to a brokerage or these lending protocols on DeFi, the amount of money that's in them is semi-fixed. It's the money that they've been granted by either depositors or they created when they created the token, and it's that amount of money that they have is fixed by the amount of money that has been invested with them. The amount of money that a bank can provide is many multiples on top of the amount of money that they actually have in hand, and that's an important difference.
Yeah, thanks, Audie. Yeah, so when an investor invests in a bank, in fact, the banks aren't using just the investment, they're leveraging that by about 33 times. But unlike a hedge fund, which does external leverage, which is really risky, banks are doing internal leverage. So it's not risky, they don't have to mark to market. So yeah, about 30, well, they can go up to about 33 times in total multiple, which is huge. And how they use this money, what the purpose of this credit that they're creating, that's what really impacts the economy and your everyday life. So if there's three cases, there's three different types of credit that can be created. Now, the first two, case one and case two, fall into the real economy, credit that's used for real economy. This determines GDP growth. This includes consumptive credit creation, which has been from about 2020 to 2022, when banks have lent large amounts of money for people to just purchase more goods and purchase more services. And the argument was made, well, this is needed because people are struggling and they can't work because of the government regulations that are in place stopping them from being able to work. So they need to be paid from the banks and loan money, all this, you know, all these excuses. However, that's really unproductive because that money can't be paid back. If I'm borrowing from a bank to buy more groceries, for example, I'm not using that money to generate more money. How am I going to pay that money back to the bank? it's just going to eventually come from my paycheck, which isn't enough for me to buy the groceries in the first place. So how am I going to repay the loan? Well, I can't. So that means you're getting GDP growth, but it's purely down to inflation because you've got more money in the system that hasn't been paid back, buying all the same amount of goods and services. So you've just got a load of inflation there. So it's really unproductive. Then case one. Now, this is productive credit creation. This is what we want, and this is what Valhalla Network can provide. This is when you get credit being created by banks, loans that are being extended by the banking system to productive businesses. And small businesses, in general, are much more productive than a large firm. They don't use the money for unproductive purposes such as buying real estate, mortgages, etc. like that. What they're using it for is investing in new goods and services. They're investing in, for example, new staff maybe that can generate them more money. They're investing in a new oven, for example, that they can bake more goods in, which allows them to generate more income stream and more money. That money is then being used to repay that loan, which means you get credit destruction. So that credit creation that's happened at the first place has been used productively to generate more money for the business that's being used to repay the loan and destroy the credit, which means you get no inflation because the fact that the money has gone back to zero. There's a net gain of zero of total money supply in the economy. However, you've got the GDP growth because you've got more goods and services and more sales happening. So that's the sweet spot, and that's what we can provide. Whereas case three is what you'll see in a lot of large banks. This is credit used for non-GDP transactions. This is financial credit creation. Now, this doesn't determine GDP. This is transactions such as a real estate market, when a big PE firm will come to the bank and say, we need to borrow 100 million from you to do this huge development project that we're working on, a real estate development project. It's massively unproductive. It's financial credit creation. And ultimately, again, it can't be repaid in the long run. Why? Because any asset market, and we saw this in Japan, for example, in 1980s and 1990s, you've got this asset market, and the more money you're creating for it, and the more money you're pumping into it, prices of those assets. Apologies if you hear something. The price of those assets going up over time because more money is being spent on them. You've got more money in the system. So the price of the assets is going up and up and up and up. And then eventually what happens is the banks can't keep lending for that purpose. They can't keep lending more and more and more large amounts of money just to buy into those assets. So eventually the tap is turned off. And then people realize that the value of these assets are completely overvalued, and actually they should be dropping. And that's when you get the bust cycle. So going back to that one of the earlier slides, this one, that is normally when you get those boom bust cycles, when you get those financial credit creation, credit being created for those asset markets, that's then being turned off. It can't be repaid. It's turned off. All those loans that have been extended from the banks are now bad loans. They can't be repaid. The bank's balance sheets are now unhealthy. They're not looking like they're capitalized. They're either going to need a bailout from the central bank, they're going to need a bailout from taxpayer, or they're going to need a bail-in or something like that. The banks can't survive. And then you get these, massive boom bust cycles that leads to everyone, depression going up, unemployment going up, all that jazz. So we're focusing on case one. So what is the solution to this? It's small and medium-sized businesses. Now, a recent study done by Werner showed that as bank size grows, they lend less to small businesses. As I mentioned earlier, they're focusing on those large businesses. So what we need to do is decentralize the banking system. We need to take the current system and start reversing the trend that we're seeing. We need to set up more banks. We need to decentralize the front end by setting up thousands of small banks that stay small and are geographically restricted to lend to their local small businesses in their local area. Now, this forces the banks not to cherry pick. So that's the first amazing thing about this is it stops the bankers from cherry picking all the best small businesses in their country, for example. It forces them to work with the small businesses in their local area and to make sure that those small businesses can grow and thrive. Also, it means that those small businesses have a bank that's going to cater for them. They're not just reliant on the few big banks, the 5 big banks in the UK, for example, and having to approach one of them and ask for a loan and never going to get one. They have a small bank that's there to cater for them, that understands their businesses, and bankers who live in the local area might have already been to the small business and experienced it, might already know the small business owners and have a good relationship with them. And ultimately, there's more trust in the system, there's more likelihood that the loan will be repaid. These community banks as well are going to be 25% owned by a charity foundation that we set up with the community bank. This means that 25% of the dividends that the bank makes, because community banks, although they're acting on behalf of the small businesses in the community, they're still profitable. They still have to make a profit as a bank. They're just not focusing on the bottom line like big banks do. They're focusing on making sure that they can help the small businesses and that the community thrives. But it still makes a profit. So 25% of the dividends that are generated are being then siphoned to the charity foundation that is set up, that has been has local leaders and representatives and community representatives on the board of that foundation that are then deciding to reinvest a portion of the dividends back into local community initiatives. So sport development programs, education programs, going into schools, whatever is needed in a local area, the charity foundation will be able to support it. This means the community bank not only is helping those small businesses, but it has a real community element to it as well. You've got the local people knowing that the bank is giving back to them as well, so that they don't feel so bad about the bank making money, because the bank is actually giving back as well. And you'll have the banks engaging with local schools, increasing financial education as well, which is currently lacking in the education system. So it's overall, it's great for everyone. And then this democratizes finances as well, because we're allowing the people to effectively govern the whole banking system that we're setting up. So how's Valhalla Network going to do it? Well, we're doing it in 3 parts. There's 3 parts to our framework. The first is the Valhalla Network DAO, the foundation that will be governed by the DAO. Now, Audie will go into this in more detail, but effectively you have the foundation that's set up, the legal real-world entity, and the DAO sits above it. They're the token holders. They're the ones who are actually governing the foundation. The foundation owns the banks that we set up. And we do this in 2 phases. The first phase is one specialized Eurozone-based bank that we set up, whose only job it is to be generating sustainable profits for the foundation in year 1. So it's going to be profitable year 1. This launches us into phase 2. So not only are the foundation and token holders happy because the foundation's making a return, so therefore overall the project is sustainable, it is self-sufficient, token holders' governance rewards are being supported by these cash flows. So they're happy, it's all happening year 1. But also, it means that we can set up community banks faster, because then all these profits that the first bank is making can be reinvested as well in setting up these community banks quicker. And community banks take a few more years to become profitable, but they take about 3 to 4 years to become profitable, which is why we first focus on the phase 1 bank that we're setting up in Liechtenstein. So our phase 1 bank, so as mentioned, it's going to be owned by the foundation itself, 75% owned by the foundation, with 25% owned by staff options and other private holders. The 75% will have preferential rights. The phase 1 bank holding company will 100% own the phase 1 bank. So that's just for structure purposes. The foundation is the ultimate end shareholder, if you like. The token holders are not shareholders of the foundation. They're not owning security in the foundation. They're not shareholders of the bank. So that's really important. They are governing the foundation. They are in control of the assets of the foundation. And then they get rewards for governing, for being active governance participants. They're getting rewards for that. Then we start phase 2. So we launch into phase 2 of setting up community banks. Similar structure, the community bank will be owned by the community bank holding company, which will be owned 25% by the charity foundation and 75% by the Valhalla Network Foundation. We are taking a model that's being developed and has been improved and perfected by the Germans, the Sparkasse or Sparkassen, and apologies, I know I always get this wrong and I get told off by my German colleagues and by Professor Werner, who's also German. He tells me off about that. One day I'll learn how to pronounce it. There's about over 1,500 community banks in Germany. These community banks, as mentioned, they lend to the small businesses in their local area. And what effect does that have? Well, it makes the small businesses in Germany way ahead of their counterparts in other countries. Why? Well, and this is what hidden champions are. Hidden champions are small businesses that are market leaders in their niche sector. Now, why are they ahead of other countries? Well, imagine you're a small business in the UK, relying on the 5 big banks in the UK. And you want to invest in some R&D, you want to invest in some new machine, let's say, that's going to make your process 30% faster, something like that. And you go to your bank and you say, I want a £100,000 loan for this new machinery, and the bank isn't interested in you, might not reply to you for a few weeks.
You can't even get the door.
Pardon?
You can't even get in the door.
Yeah, exactly. You're not having a face-to-face meeting either, by the way. This is being done over the phone, digitally, online, whatever. You're not even having a face-to-face meeting with this bank. They don't know who you are. You don't know who you're talking to. And quite honestly, they don't care. They don't care about you. They're just focusing on those big businesses, those big PE firms that are getting their growth. So you're not going to get the loan. Whereas a small business in Germany, they've already got a fantastic relationship with their community bank. Their bankers, the local bankers, know their business. They might have been on very good terms with their father and their grandfather who set up the business, 60 years ago or whatever. They've got this multi-generational relationship with their community bank. So really strong ties. Their community bank trusts them. They trust the community bank. Obviously, they still have to pass all the credit checks and everything like that. Everything still has to be done as a bank-style lending process. But the point is, they get in the door, maybe even on the same day. They get to sit in front of their banker that they know very well and talk through their business plan, talk through why they need €100,000 loan in order to invest in the machinery. And the community bank turns it around for them either on the same day or next day or within a week or something like that. Normally, it's very, very quick. Which means that they are then way ahead of the competition because that machinery that a UK business can't get, the small business in Germany can, which is why there's so many hidden champions. And as you can see, geographically, it seems to be that where there's more community banks in Germany, there are more hidden champions. There are more small businesses who are leaders in their segment. And that's not a coincidence. So what we're doing is we're doing the same. We're setting up these community banks. Now, each community bank we set up, as I said, it will take about 3 to 4 years to become profitable and start generating those profits for the foundation. After 5 years, it would have supported over 2,000 small businesses. And after 10 years, it would have generated over 5,000 new jobs for the local area, for the local economy. And that's each community bank. And that's just 10 years. And then the next 10 years is even more than that. So you're countering unemployment. You're making sure those small businesses that are not served are being served. You're making sure those jobs that would have been losses are preserved. So overall, it helps everyone. Audie, take it away.
Yeah, so going back to the governance part of this system, what we want to differentiate is the governance. The people who hold tokens do not own or govern the banks because that is a real world entity that's very highly regulated and it needs to be legally separated from any influence of that is undue. So we need to be very careful about how we set this up so that we can act in the real world. A lot of decentralized autonomous organizations out in the Web3 world don't have to worry about real world impact. They can avoid that or be jurisdictionless. In our case, we must have jurisdictions because we are operating banks. And so we've established a foundation to represent the DAO in the real world. And the DAO will fully govern that foundation and the assets that it controls. And of course, those assets that it controls include the holding companies for the banks, and through that ownership, the DAO will receive the majority of the dividends of all of the banks inside the system. And what that means is that
the foundation will receive the dividends.
Yeah, the foundation.
The DAO will receive governance rewards.
The foundation will receive the dividends. And what that means is the DAO will be governing the use of those funds towards the mission, which includes the community banks that Holly covered so well, the charitable foundations, and of course, maintaining the mission, which is to create more and more community banks and keep this thing alive for the next century or so. So we want to try to really change the way banking is seen through education and all those things. So there's some other ancillary missions that we're going to include. Again, the token holders will have authority over the use of those resources in the foundation. We will as a community drive the mission forward using those assets and ensuring, of course, that we can pay out the rewards that we've arranged to pay out. The governance, however, DAO governance is slow, and you've probably heard stories about this if you're in the Web3 world. Governance, there are some people that they were hacked. I can't remember the name of the company, but they were hacked, but they couldn't actually govern for 3 days. And so the hack was wide open because they couldn't change anything for 3 days because of the way it was set up. Governance is necessarily slow, and that's okay. In fact, if you go to a standard equity organization, the governance is so slow that all you do is once a year govern perhaps which people are on the board, and that's all to say you have in the company. We at Valhalla want people to be more involved and more aware of what's going on and help us accomplish the mission. And so we will be working toward having open governance on a regular basis, but we are also aware that we can't operate in real time with governance, and there's going to be no attempt to do so. So part of our governance will be including a board of directors, and the board of directors is going to have an important responsibility. The DAO could vote potentially to, give money to gun runners or something, right? It's something illegal, right? And because we're a real world entity with real world concerns, we can't afford to make illegal decisions or illegal options. So the board of directors will be keeping the DAO's governance on the rails. They will be fiducially responsible to the DAO. But the DAO could make a decision that is, flies in the face of some jurisdictions' laws. And we need to make sure that that doesn't happen because we're running a bank here, and that's a pretty serious business. So the board of directors will be responsible for keeping the DAO's governance on the rails and being a safety mechanism for that, just to make sure that we don't accidentally violate some jurisdictions' laws. So they'll be helping us in that way. But there's also going to be an executive arm to the foundation, because some things just require a response within the next 10 minutes. And there's no way you can get a DAO to govern the next 10 minutes. And so we're going to govern responsible parties and committees to make sure that under emergency conditions, things can happen to make sure your funds are safe, right? And make sure your governance is represented well throughout the foundation and all of the add-on charitable foundations and things like that. The things that we need to do in real time can be done. So the governance will be establishing the way we operate and who is responsible for certain activities. But we want to make sure that we both have a rich DAO governance structure and the ability to respond in real time, so that we are making sure the system operates efficiently and works well. And that's the way that we will have a balance between that involved governance that we're actually going to reward significantly, and the ability to operate day to day with a real world operation like a foundation. Ollie, can you advance the slide?
Yep, and also just to make clear that we don't have a choice on the foundation either in terms of there needing to be a board in place. Because we are setting up these fully regulated banks, the foundation is also regulated in the jurisdiction we're setting up, and it's also going to be regulated. There has to be a board in place, otherwise, well, we won't be able to set up the foundation. But also, because we're setting up the banks, you need to have, and they're regulated, you need to have that intermediary that can effectively veto anything that is illegal, anything that is against regulation. And that's what the board is in place to do. There's bylaws, and we're currently in the process of setting up the foundation. It's been a long process because we first needed to design it properly, make sure we fully understood what we wanted the system to work as, how we needed the token holders to interact with the foundation. So that needed to be very clear before we could set up the foundation, because you can only set it up once. So you need to be very clear from the start. And we're now in the process of doing that, having the bylaws in place, having the articles referring to token holders, and making sure the directors are acting in the interest of the foundation and the token holders and stuff like that. It's not the most simple foundation to just establish. But also you need executive arm, because someone needs to do something. Someone needs to actually put something in action. This isn't all done on chain. We're actually doing something in the real world, impacting stuff that's off chain. So someone needs to be the one to get on with it and do it. And that's the purpose of the executive arm as well.
And that's a great point, Ollie. But we want to make sure that we go across the finish line here with governance in place, because we need to be operating on day one in order to get ourselves to profitability with the banks, make sure that we can handle the dividends that are flowing in and things like that. Everything will be subject to governance, but we are going to bootstrap governance that makes sense and is as minimal as we can make it, so that most everything that we do will be subject to governance, as long as it's within the legal limits of what the foundation is capable of doing. Everything will be subject to governance, and there will be an opportunity, and I'm going to go into how we're going to do this, but there's going to be an opportunity to create governance from within the system. So governance, a lot of governance in Web3 is relatively difficult, even if it's something gasless, which we intend to do, something that's reasonably free. You of course have to hold the tokens, but we don't want you to pay to vote. So we're setting up a system where you will interact with the blockchain, but it's not something where you have to pay to vote. That was a non-starter, because we want you to actually vote. So if you're having to pay $30-40 a vote, depending on the price of Ethereum, that's just a disincentive to vote. And we really want to see an active community here. But we're going to have a snapshot voting system that governs a Zodiac fueled Gnosis safe. So this is a multi-signature wallet on Web3. The multi-signature wallet is enriched by a series of governance tools that allow snapshot votes to directly act on the wallet. And in fact, it's powerful enough that you don't actually have to have owners on the wallet. The DAO can be the owner directly. So we've already arranged in our bootstrapping governance that we're going to have 50% of the assets be in the foundation's hands in fiat for operations that are in the real world, and 50% of it will be in the DAO's. Sorry for the noise if that's making noise, but 50% will be in the DAO and 50% will be in the foundation. So 50% of those assets will be controlled directly by the DAO, and 50% will be controlled indirectly through the foundation.
And it's also to minimize risk, because obviously if you have all your treasury in one place and something goes wrong, let's say the worst happened and something went wrong or something, then the project is you're at critical point there that it might not survive. But if you've got it separated into two spaces, then at least if something terrible was to happen, at least then you've got a backup. The project isn't going to fail. So that's another good reason to do this, that a lot of projects are missing at the minute.
Right. And remember, the assets of the DAO and the foundation and the overall system will be generous. Like this is a bank. So it's a for-profit bank that's going to be profitable inside the first year. That's the anchor bank. And then there's so that's the engine. And then the mission is, of course, using those funds to start up community banks around the world. And as we drive into that mission, the amount of money that we're talking about is pretty significant, because it takes money to start a bank. Ollie could go into more details, but it takes tens of millions of dollars to even start a small local community bank.
And this isn't in cost either. I'll come to this on a future slide. It's not in cost, but it is in capital. The amount of regulatory capital you require to start up a bank.
So we talked about leverage. You got to have something to lever, right? So, and that's where that significant amount of capital comes in. But once those banks are profit making, and the phase one bank is intended to be profit generating in the first year. Once those are profit generating, all of those funds, all those dividends will be under the control, or at least 75% will be under the control of the foundation for the establishment of the mission. That's a significant amount of capital, and we need to have effective governance for it. And so we have designed a system that will reward people for governance. Typical staking is like just stick your funds in a smart contract somewhere and let it sit and just get an APY, right? Like that's the intent of staking. The intent is to make sure that you don't sell your token, and that's not what this system is built for. Like of course, we think you should hold your token, but that's because we think it'll be valuable. We think it'll be something valuable to pull that governance And
reason to hold the token is because just be wary of Mark Jolly in the background. I had
in
the background. I'm probably
I'm talking about the governance, right? I'm talking about the governance. So that in itself, like the ability to push a community banking mission forward, is what is valuable, right? And we want that. We want your participation. We want to actively incentivize that participation. So we're doing that in a couple of ways, and the way that's probably really at the front of everybody's mind is what's the percentage, and we're going to start rewards commencing if you fully participate in governance, you can make 5%, right? And that's these are adjustable and subject to governance. That's just where we're going to start.
That's at the start of a token generation event, right at the start. And that's how we see it, and then it will go up. But it's also open to token holders, so it's open to the DAO to decide on these things. It might be that the DAO, after 2 months of us launching, the DAO says, right, we vote and we have passed it, that it goes up to 7% because we have enough coming in that we can support a higher rate.
Right, and these are the things that we will govern. So remember, the mission is create community banks, but also we want Valhalla Network to last for a century or more. We want it to last for a long time and create a lot of banks, and make that red line, that solid red line where we're killing that boom and bust cycle. That's what we want. That's the mission. It's a big mission. The other way we're going to make this easy on you is a lot of DAOs require you to log into a website, sign into something with a wallet. You'll still have to do that. You'll still have to, but we're also going to put that power of that governance in your hand. So we're going to have the D app and the website be something that you can do on your phone, and you'll get push notifications. So you don't have to think about it. You don't have to remember to log in. It's just something you can sign up, and you can download an app and be fully involved and fully aware of what's going on. Hey, it's over here. It's over here. Sorry.
Great.
So yeah, and so we want you to be involved, and we want you to be a rich part of this community, and we want you to have the understanding. So it won't just be the governance that's being driven to your phone. It'll also be like explanations. What are we doing? Why are we doing it? How is that governance happening? Because there's important steps toward rich, useful governance, and you have to make sure that you're doing this in an ordered way. And so we'll have conversations about it on a tool called Discourse, to make sure that the community has a say in what we're voting on. And then as we approach the point where it needs to be voted on, then we move that into a snapshot vote, and that snapshot vote determines the future of the foundation and of the DAO and of the community banks.
Great. Thank you, Audie. And also, it's not going to be a linear voting system where one token equals one vote. The way it will work is to try and decentralize the governance system as much as possible. And the voting is that the more tokens that you have and you hold, the more expensive votes become, if that makes sense. So if you have, let's say, 1,000 tokens and you buy one more token, that extra token will have less voting power associated it. Whereas if you had 100 tokens and you bought one more token, so therefore, even if you own 70% of the supply, let's say you were buying up all the supply all the time and trying to, centralize the system and have all the supply, even if you had 70%, you might only have about 24, 23% of the vote. The exact formula, I don't think it's been calculated yet, but it's to make sure that even if you had 99% of the supply, I don't even think you'd have 50% of a vote in that instance, because it becomes so expensive to get that extra vote, because we don't want it to be centralized. We don't want one or a few people to have so much power that the community is there's no point in it. So we're going to make sure that it is certainly not linear.
Right, and that's an important point in that there's established examples that we're going to be building on, things like the Gitcoin rounds, or certain fundraising models that have things like quadratic voting. The power of larger numbers of voters is something that matters in a system like that, whereas in a pure one token per vote, or one vote per token system, if you own 51% of the supply, you essentially control it. Remember, we're trying to decentralize banks. we can't do that if we build a system that allows somebody to purchase all of it. And this is a necessary protection because, you know, some of the people in the world that have a decent amount of money might not like that we're creating a system like this that decentralizes banking. And so we want to make sure that it's not even possible to just purchase Valhalla Network and shut it down. Like that shouldn't even be possible. We want there to be, like we said, our mission is community banks and to survive, right? And to make that happen, we have to decentralize. That doesn't mean that somebody can't execute a lot of power in the system, but we do want to make sure that if a lot of people go against that one person, that one whale, that it matters, and it's not something that the little guy feels like they're shut out of the system.
Great, thanks, Audie. So to very briefly to touch on the team, so Professor Richard Werner is the chairman of the project. I've worked with Richard for many years now. So Richard is actually the inventor of quantitative easing. In the 90s in Japan, he invented and coined the term QE, which has been used incorrectly by the central banks for many years. He invented it for a very specific purpose to recover an economy following a boom-bust cycle and to get it out of a recession very quickly. He also is the inventor of a quantity theory of disaggregated credit, which is the theory of that banks create credit and how they create credit. And so far, it has not been disproven. You know, the other theories, the financial intermediation theory, the fractional reserve theory of banking, they've all been disproven. Funny enough, by Werner. But in 2014, Richard did the first ever empirical test to prove that his theory actually has legs and has empirical evidence supporting it. I myself came from HSBC, worked there for a few years before I decided about enough was enough. I resigned from there in sort of disgust to the big banks. You know, I didn't want to work for a big bank all my life. I wanted to work for small banks, to set up small banks to help small businesses. I'm also a director of Local First Community Interest Company with Richard, where we promote community banking in the UK and obviously across the world. And I founded the project about a year and a bit ago now. And then moving on to the rest of the team. So Audie, who's been speaking and you've met, he's our CTO. He's got over 40 years of experience. We've got Borja, who's been working closely with Rich and I for a while as well now, who's on the finance side and also on the banking side. So he's leading the banking application process. We've got Mark Jolly, who's on the call as well, who's been head of compliance, or deputy head of compliance for Arley United Bank, has worked in compliance for over 20 years in various banks. Is now getting his head in the Web3 space and the compliance of that. And also he's working with Borja on the banking application process as well. We've got Z on the business development and then Mark Mottershead as well, who's on the call on the marketing side. And then our success to date, well, we've raised over 7.7 million euros. We've had no VC capital. We've not accepted any VC capital, and we've got no restricted terms. Normally VCs approach projects, good startups, and they try and have very aggressive, nasty terms attached. We don't accept that. We are very, simple. This is what we're offering you. Either you can like it or you can lump it. As far as we're concerned, we know that it's a really good offering. We want to protect our investors. And if we accepted anything which was restrictive or any aggressive capital coming in, then it wouldn't be acting in the best interest of our investors. So we are very select with who we accept. And our current investors are long-term. They're committed private investors. They're not in it for the short term. We don't allow that. The way we work is very different to a lot of companies. Private investors come in and they're vested. They're vested for 1 year. They're locked in for 1 year after we go through the token generation event, meaning they can't just dump on the public. A lot of projects, they have private investors come in, especially VCs, who will dump on the public as soon as it launches, bringing the token to zero, making the project look like it's failed, bringing the community down, and overall it's very hard for a project to then succeed and to ever get out of that. We're preventing that by selecting our investors and making sure that they're in it for the long term and they want this project to succeed and they understand the mission, and also that they're locked in for a year after we go public. The team is locked in for 2 years plus another 2 years, meaning 2 years after we go public, and then over a following 2 years, our tokens gradually unlock. This means that investors are fully unlocked and fully liquid before the team gets 1 token, meaning that it prevents us from trying to rug pull or try and pull the wall over people's eyes or trying to get out before any investor or anything like that. We are saying, no, we're not going to receive any tokens until after the investors get everything that they want, that they've paid for, and that the public have everything that they want, so that they can get out if they really want to get out, and that they can before the team get anything. So it shows that we're committed as well. We're in it for the long term. We believe in this mission and we want it to succeed. We're currently in our private round 2, and we've got about 3 million left to raise in this round before that closes. We're not in any rush. We have raised enough money that we can complete the application process, submit the application with our regulator, the FMA in Liechtenstein, and continue to raise while we're in the application process with them, so that when we eventually receive the license, either we'll have the minimum amount of capital that's required, or the bank regulators will say to us something along the lines of, okay, well, look, you're ready for the license, but you need to raise the rest of the capital, at which point, if you've got the license pretty much thumbs up, then it should be much easier to raise at that stage, which is why the closer we get to receiving the license, the discount rate that we offer to our private investors keeps falling, so that at the moment it's 61%, and then gradually, as we complete more and more milestones, the discount rate will lower and lower, regardless of which round we're in. If we are filling that round, or if we're not filling it because we're not aggressively going to the market, the discount rate will still be lower to account for the fact that we are completing milestones, and it's only reasonable and fair on our early investors who have supported us already and are coming in now and supporting us as well, so that someone who comes in a year's time, they aren't getting the same discount rate as someone who comes in now. And then our public round will be about 55 million. So in private, we're raising about 22 million in total. And then when we go public at the token generation event, we envisage to raise 55 million. So that the first bank is effectively having about 75 million worth of capital there. So what are we actually using the money for? What are we using investors' money for? Well, to build the DAO, to start with, building that technical framework that Audie was speaking about, establishing the bank, establishing the phase 1 bank in Liechtenstein, and submitting the application with the regulatory body. Now, we envisage that bank setup cost will be about 3.7 million. Now, that's a very generous, I'd say, amount that we've budgeted for that. It could be a lot less, but we decide to over budget rather than under budget, meaning that in total, under 20% of investor capital is actually being spent on costs. Over 80% of the amount that we raise from private investors is purely for regulatory capital for that bank, meaning if we do not succeed in getting a bank license, over 80% is there to be returned to investors. Whereas unlike a lot of startups where investors are coming in, they're risking 100% of their capital and 100% of it is being burnt, in our case, we're saying no, regulators will do more due diligence on this than any investor will do. They'll tear our business model to pieces, and they will review the banking team that we have in place, everything like that. And if they are happy and give it the rubber stamp, then your capital is on the line, because then it's being used by the phase 1 bank as regulatory capital. However, if they do not give us a license, and let's say for some reason the investors and the team decide, okay, we've tried for long enough, it's not working for whatever reason, then over 80% is still sitting there to be returned to investors, whereas only under about 20% has actually been used on cost.
That is not an outcome that we expect.
No, of course, it's not an outcome that we expect. And regulators are not, especially, some regulators are different, but the majority of regulators, they're not evil. They're not trying to do anything bad. They're just trying to make sure that what you're setting up is, firstly, it's within regulations, and 2, it's going to protect depositors of the bank, and you're doing something to help the economy, and that the bank will be profitable, and various other metrics. They're making sure that it's a good business model, that they're not being irresponsible by giving you a banking license, which is the hardest license to get. But that means that they don't just say no and close the door and that's it, you're never coming back. If for some reason, and this is very frequent, it's very common for this to happen, and we expect it to happen in our project as well, is that the regulator won't say no, they won't say yes. What they'll probably say is something along the lines of, you need to make some improvements in this area, or you need to focus on this document a bit more, or you need to do some more work here. They give you some guidance. They try to be collaborative with you. They try to work with you to make it so that your application is as strong as it can be, and that when you set up the bank, it's as strong and reliable and responsible as it can be as well. So we don't expect it to happen that we'll have to pull the plug completely and 80% will have to be returned. But it is a very nice, it's a very nice offer that we have, especially considering the current economic climate and the fact that investors are looking for somewhere relatively safe haven that their funds can start earning a return in whatever way. The roadmap. So like I said, we completed the seed raid last year very quickly. We completed round one relatively quickly as well. And we began our bank license application end of last year. It took us a while to confirm the jurisdiction of choice, which has changed from the original white paper, as any of you more aware of amongst you who have read the white paper carefully and have noticed that I talk about Liechtenstein rather than Luxembourg. Again, it's because we were spending last year properly reviewing the different jurisdictions, getting to grips with their regulations, market research as well, speaking to various people and deciding which jurisdiction was best in the long run. We've now started the application process. There's a preliminary banking application process to start with, which is voluntary, and we're completing it. So the documentation has been completed for that, and it's now with our legal counsel, who is now going to review it and then ultimately submit it for us to the regulators. And we expect to happen in the summer or towards the end of the summer this year to submit our full banking application with the regulators, and then to start the testing on testnet as well on the technical side. And then Q2 next year at the sort of latest is when we expect the phase 1 bank to actually launch. We expect that to be when we do the TG and ICO as well. So that's when we want to do the public raise on the sort of marketing of the fact that we're getting this banking license. We're going to try and use that to push us into that 55 million raise, which we expect to have a big impact, because you can imagine in Web3, not that many projects have any sort of banking licenses associated with them. And also the reward functionality and the whole DAO should be set up in time for the TG and ICO, so that governance can start through the DAO at that time as well. And as I've said at the start, if the right conditions exist, communities all over the world, including developing countries, especially developing countries, can thrive. It just requires us to set up these community banks, and together we can create these conditions. Thank you very much, everyone, for your time. I will have a few Q&A now for anyone who wants to stay on, listen to some Q&A, ask any questions. I've got a couple of questions already from people who have not been able to join the call, who wants to ask some questions. Audie, thank you as well for taking us through. So I think the first question, if you've got any, please put it in the chat. The first question coming from someone who's offline for you, Audie, and I hear it quite often as well from people, is what would happen to Valhalla Network? What would happen to our token? What would happen to the value of the investment if for some reason Ethereum that we're building on, so our token is being built on Ethereum, it's an ERC20 coin. What would happen if Ethereum went down for some strange, peculiar, unlikely reason? Ethereum went down.
Okay, so first, to make sure what Ali said was clear, we're launching an ERC20 token on Ethereum. Ethereum is second to Bitcoin. It's one of the first altcoins, I suppose, that was launched, and it has the distinction of being the only other blockchain project that has gone as long as it has without going down. So the question is probably not really that big a concern, but let's assume the worst. Let's assume that Ethereum does go down. So we will be maintaining a lot of metrics around who the holders are, how much we have, people participating and things like that. And we'll be operating on snapshot. If the Ethereum goes down and the token is suddenly not functional and snapshot can't get the results of the question, how many tokens do you have, we will have lots of reporting that will be recording this stuff. Remember, governance and day-to-day operations are separate. The day-to-day operations will be governed and can continue to work on existing governance. And then while Ethereum either comes back up or we have to figure out a way through, we can use metrics and our existing balances at the time it went down in order to continue to work. We will need to govern this to make sure that it's done equitably and fairly. But this is something that we, under emergency conditions, we will have guidance for.
Thank you. That's good to know. So I've just had a question from Daniel come through. Thanks, Daniel. Why not just make a neobank like Revolut or Monzo? So this is a brilliant question, and I love this one. So to start with, Revolut doesn't have a UK bank license yet. Correct me if I'm wrong, Mark Jolly. I still don't think that they've received their license yet in the UK. So first off, they need to have a license, and every bank that we set up is going to be a fully regulated bank, meaning it can create credit. That's the key part, so they can get that economic growth. Secondly, Revolut and Monzo, they don't offer in-person customer support. They've not got branches. They're not focused on the local small businesses with local bankers who visit those small businesses and do traditional face-to-face banking. So to be very clear, the community banks that we set up will offer traditional face-to-face banking services. They're not going to force their customers online. They're not going to, force them to just go through online channels to speak to them. They're not going to force them just to use telephone services or whatever. Of course, those services will be available to those customers who do want to use them and make use of them. But they will also offer those traditional face-to-face services for people who aren't necessarily either one, don't have the means to do digital banking, or two, they don't like it and would prefer face-to-face, because as you can imagine, you're talking about very confidential things. You're talking about your business plans. You might be talking about something that's going through at the moment that's a struggle for you and you need financial help from the bank. It's a conversation you don't want to be having over a live chat or over a phone. You want to be sitting down with someone that you have spoken to before, you recognize their face, you trust them, and they trust you, and you can have that very private and intimate conversation with them about your business, which is your life. If you're a small business owner, normally the small business is your life, and you will be talking to them, and it's very important to have that. And Revolut and Monzo and other banks like that do not offer those services.
As far as the Web 5, I'll take that question. So Web 5 is a relatively new thing, and I'll be honest with you, as a CTO, I like to choose boring technology because it gets things done, and it gets things done in a trustworthy way. If you run headfirst into the new stuff, you'll end up pinioned against your choice, and that's not a good place to be. Ethereum has a long history. ERC20s have a long history. Snapshot and Gnosis has a long history of success, and so we will be using those because we can trust them. That doesn't mean that we won't entertain new technologies as they do establish trust, but we will not be going with the new and hot thing because it's just it hasn't been through the crucible yet, and we want technologies that have. And that we are building a system that is focused on longevity and reliability, and we can't afford to go with the new thing. Internet identity, though, is something that's near and dear to my heart. I understand why it's important. The idea that an address is an identity is a mistake, and so we need to fix this, and we'll be keeping an eye on this. We will be able to govern changes to our technology as we go forward.
Great, thank you, Audie. And then I got another question before as well about the fundraising environment. Again, this was offline and how it's coming along for us. So obviously everyone's aware of the market and sort of the instability that's there at the moment, and obviously the crypto market, especially being down as well, doesn't help things because it offers more opportunity for investors, effectively, and more choice when the market's all down. So the markets are looking like they are climbing this year, somewhat steadily and not always predictably, but they are looking like they are going up. And we have seen more interest lately, especially Q1, from especially sort of smaller investors as well. I get lots of emails from smaller investors asking to invest around the €30,000 mark, which is our minimum investment amount, is accepting €30,000. This is because of how much we're raising. Accepting any smaller amount than that, I would only be on the phone completing documents and accepting money all day long. So we have to set a minimum. We are seeing more interest. Like I said, we're not aggressively going to the market. I am doing more talks. I have more speaking opportunities coming up this year as well. I've been invited to a few other countries as well to do talks. And Richard as well, Professor Werner, will be doing an interview with me in the next couple of weeks. I spoke to him last night about it. So he'll be getting more involved as well and doing more marketing with us as well to help spread the word. So we should see interest picking up. And like I said, I'm not concerned about it at all. being aggressive about going to the market, and we are just very much allowing investors to find us, and if it's right for them and they are right for us, then the investment will work. But if anyone wants anything in particular, especially the investment deck, which has a little bit more, these are more presentable slides. I have a deck which has a lot more words on it, not really meant for presenting. So if you prefer the sort of investor deck, please let me know, and I will email that to you. Or if you have any questions about our investment process, please let me know. It's relatively simple. If you want to invest, first off, I normally have a call with each of our investors so I can understand, firstly, who they are, and secondly, so that I know that they're fully aware of what they're investing in, and that they have the opportunity to ask me any other question that they have. So normally each of the investors, I think almost all of the investors that we currently have, I've spoken to them on the call before they invested. And if I didn't, I gave them the opportunity to speak to me before they invested. After that, it's a simple document. It's actually called a simple agreement for future tokens, whereby investors are effectively reviewing documentation that says that they're purchasing tokens in the future. So in the tokens that are being generated in the future, they're purchasing now, and for purchasing them now, they're getting them at a discount. And it has various terms that state that if we don't fulfill certain conditions, if we do not generate the tokens by a certain date, then we owe the money back, etc., etc., etc. That's the document. It's a SAF, the Simple Agreement for Future Tokens, that's used in almost, I think, every Web3 project that is starting up and selling tokens before they do the token generation event. Once the document has been signed and returned with a copy of the KYC, so copy of your identity and proof of address, and we require that because we're setting up banks, every investor we have to know where the capital is coming from, so that the capital we're using to set up the bank, we have to be able to prove to regulators, if they ask for it, that all those investors who have provided that capital have done full KYC, so that we know that the money's not coming from any illegitimate sources for the bank. So it's a relatively simple process. When will you start? When will we start? What exactly, Stefan?
So I'll answer that question. So Stefan, when we will start? Currently, we've already begun. We are fundraising. We are building the technical solution and the banking. We're working toward the banking license now. We expect all of this to culminate in a token generation event in late Q1 or probably in Q2 of 2024. So next year, a little bit toward the end of the first half, we will be doing the token generation event and going full operational with the bank. All of this, of course, depends on the banking license itself. We want to be fully operational with the banking license before we do the token generation event. So that's the big crux. That's the biggest problem that we have to solve, and that's the thing that will determine when we actually start. But I hope that answers your question.
Great, excellent. All right, thanks everyone. We'll wrap up here. I appreciate you all joining, and we will share it out on social medias and stuff anyway. So if anyone missed anything, you'll have the opportunity to rewatch it if you so desire. Thank you, Audie, for your time as well today, and for everyone else. And anyone, feel free to get in touch if you have any more questions. Cheers, all the best. Take care.
Thank you, everybody.
Bye.